Hello ladies and gentlemen and anything in between. Today we will be doing an income statement and statement of financial position example question. Before we start, we must know what the keywords mean. Discount allowed are discounts we give to customers. Discount received are discounts we receive from suppliers. Trade receivables are customers we sell to on credit. Buy now, pay later. Trade payables are supplies we buy from on credit. Buy now, pay later. Drawings, money we take out of the business for personal use. Capital, any money we invest into the business. Depreciation, a reduction of the value of an asset over time. Okay, so this is our first question. It says the following information has been extracted from the books of the account of David D. Tal at 30th April 2016. Please prepare an income statement and statement of financial position. We also have a little note on the left which says inventory at 1st of May 2016 was valued at 16,300. This is closing inventory. We must not forget this. Alright, so these are the 4 steps we must always follow. So what is the first step? Draw your layouts. Okay, so I've drawn my first layout for income statement. If you want to follow along with me, please write this down. At the top, we have the title. Let me write the business name. Our business name is David D. Tal, as we've been told in the question. Then we write the date, 30th of April 2016. Okay, so now we create our statement of financial position. And again, we have to write the title with the business name and with the date. If you're not familiar with the layout of income statement and statement of financial position, I have posted a video talking through it. So if you're interested, just click on my profile or I'll put it in the description down below. Alright, so now we've done that. What's our second step? Deal with any year-end adjustments. Alright, so let's go check and see if we have any year adjustments to do. On the left side of your screen, it says, note, inventory at 30th April 2016 was valued at 16,300. This is our closing inventory, so we must include it in our income statement and statement of financial position. Just so we don't forget about it, we will put it in the figure at front of us. Okay, so we write inventory at 30th April 2016, or we could write closing inventory. It doesn't matter which one you write. And then next to it, we write 16,300. Okay, so now we've done that. Let's proceed to our next step. Transfer over your figures. Okay, so the first one on the list is revenue, 250,000. So I go into my income statement and I simply put it into revenue. Alright, so the second one on the list is purchases. So I go look at purchases is 156,000 and I go into my income statement and I simply write 156,000 next to purchases. Okay, so the third one is sales return, 5,400. So I repeat the same process. I just put it next to sales return. The next one is purchase return. Purchase return is 7,200. Okay, so the next one is discount received. Some people get confused with this. They don't know what it means. Discount received is when you receive a discount. So if you put a discount onto something, you will pay less. That means you are left with more money, which makes it income. Discount allowed is the opposite of discount received. So if discount received is an income, discount allowed should be an expense. So I put 3,700 next to discount allowed. Next on the line is inventory at 1st of May 2015. This is the opening inventory. This is what we started with. So we go into the income statement. We already have it written down and we just put it next to it. Next, salaries. Salaries is an expense. We have 46,000. So we go back to our expense and underneath expenses we write salaries. The next few are electricity, rent and rates, sundry expenses. Those are all expenses, so I won't be talking through those.
property. Property is a non-current asset. This is because the business is going to keep it for more than a year. Anything that you keep for more than a year is a non-current asset. All our assets will go into our statement of financial position. So underneath non-current asset, I will write property, and then on the last pound sign, just underneath it, I write 100,000. The next one is equipment. Equipment is a non-current asset. Again, this is because the business's interest is to keep it for more than a year. Trade receivables are customers we have sold to on a buy now, pay later basis. So they owe us money and they should be paying back within a year. So that makes it a current asset. Next on the list is bank overdraft. Bank overdraft is when we have taken out more money within our balance than we have. So we owe the bank money. Bank overdraft is for temporary use, so we will be paying back within a year, which makes it a current liability. Cash. Cash is physical money we own. And if you think about it, cash changes. We won't be having the same amount of cash every single year, which makes it a current asset. Trade payables. Trade payables are the opposite of trade receivables. Are suppliers we owe money to. And because we will be paying them back within a year, makes them a current liability. Next is capital. Capital is money we've invested into the business. So we go to our statement of financial position and put it into the finance by section. Drawing. Drawing is money we've taken out for our personal use. So again, we go back to our statement of financial position into our finance by section and we just put it in there. Long-term loan is money we've borrowed with the intention to pay back in the long term. This makes it a non-current liability. Okay, so last but not least, we have closing inventory. Closing inventory will be put into the income statement and statement of financial position. Okay, so now we've done that. Our last step is to calculate. You will always have to calculate the income statement first because the profit or loss of the year will have to be put into the statement of financial position. Our first calculation is net sales. It's sales revenue minus sales return. Second on the list is cost of sales. It's opening inventory plus purchases minus purchase returns minus closing inventory. Next, we have gross profit. Gross profit is net sales minus cost of sales. Other income. Other income, we only have discount received, so we don't really need a calculator for that. It's 2,500. Next on the line is expenses. Discount allowed plus salaries plus rent and rates plus electricity and gas plus sundry expenses equals 59,400. Our last step will be to calculate the profit or loss of the year. So we get gross profit plus total income minus total expenses. We get a value of 42,850, and because it's a positive, it means that it is profit. Okay, so now we have the profit of the year. We must put it into the statement of financial position in the finance by section. We repeat the same process as the income statement. We start calculating each individual sector. Okay, so first on the list is non-current assets. That's a property plus equipment. We put the value in total non-current assets. Then we have current assets. That's trade receivables plus cash plus closing inventory. Then we put that into total current assets. Current liabilities. We have bank overdraft. We have trade payables. We add them up and put it in total current liabilities. Okay, so now you're wondering what net current assets are. That is total current assets minus total current liabilities. Then we have total non-current liabilities. We only have one non-current liability, so we just put 11,500. Net assets is total non-current assets plus total current assets minus total current liabilities minus total non-current liabilities. I know it's a long calculation, but it is what it is. Now we are finally at our last step, where we calculate closing capital. This is opening capital plus profit of the year minus drawings. You know when you've done it right when closing capital is equal to net assets. Now we are on our second question. Our second question says the following trial balance has been extracted from the books of account of Mandeep, a sole trader, at 30 November 2008. Prepare an income statement and statement of financial position. To be able to do this question, you must know debt click. DED stands for debit, expense, asset, drawings, and CLICK stands for credit, liability, income, capital. I've put it on the screen for you. This basically means the numbers on the left side of your screen are debits and the ones on the right are credits. So you would put your expenses on the left and you would put your incomes on the right. Okay, so let's continue with this question. The first thing we should be doing is drawing our layouts. As you can see, I've drawn my layout again, and on the top I will be writing the title, which is Income Statement for Mandeep as at 30th November 2008. I will be doing the same for Statement of Financial Position. I'll be putting the title on the top, Statement of Financial Position of Mandeep as at 30th November 2008. Our second step, deal with any year adjustments. Okay, so I'll put the year adjustments on another slide because it was too much. So the first one is stock at 30th November 2008 was valued at 39,750. This is closing inventory. Just to make it easier for you and for me, I would be writing down the working out. So I'll be writing number 1, closing inventory will be put into the income statement. Closing inventory will be put into the statement of financial position. So when I do the putting the figures into the statements, I will not forget. I will be putting the figures into the trial balance as well. This is not mandatory, but it's better to do so because when you're transferring the figures, you're usually using the trial balance, so it's easier that way. Second adjustment. During the year ended 30th November 2008, Mandeep had taken 2,550 of goods for his own use. This is a drawing adjustment. We will have to put this value into drawings and also subtract it from purchases. You will get the purchase figure by going back to your trial balance, and then it says purchase and sales, and we know that purchases are an expense, and debt click tells us that expenses are on the debit side, on the left side. So we can simply look at the left side and see the value. I will also be putting this into the trial balance, so when I'm transferring the figures, I will be transferring the new figure. Third adjustment. The third adjustment says, at 30th November 2008, wages due and unpaid amounted to 5,780. This is an accrual expense. It's basically telling us that we haven't paid that amount. Okay, so we will go back to our worksheet and write it down. Accrual expense 5,780, and then we will have to add that amount to wages as well. So we will go back to our trial balance and see what our wages are. It's 120,000. So we do 120,000 plus 5,780. And we will put this into the trial balance as well, so when we're transferring the figures, we will not forget. Number 4. Rent paid for the year ending 30th November 2009 amounted 4,200. This is a prepayment. This is extra money we've paid. You might be wondering why. Why is this extra money? How do we know it's extra money? Because it says 2009 and our income statement is for 2008. Okay, so we will go back to our worksheet. Prepayment 4,200. And then we will have to subtract it from rent and rates. So we will go back to our trial balance, look at rent and rates, get the value, and then simply subtract it. And we will also put this into the trial balance so we don't forget. There's a thing I haven't done that I hope you've picked up on. Basically, I haven't added the accrued expense, drawings, and prepayment onto my trial balance. Without them on my trial balance, I will just get confused when transferring my figures into the statements. The prepayment is an income, so it will go onto the credit side. And the accrued expense is an expense, so it will go onto the debit side. Drawings is just drawings, and that clicks tells us that drawings goes into the debit side.
Number 5. The provision for doubtful debt is to be 5% of trade receivables at 30th November 2008. When you're reading this, it sounds a bit complicated, but when you actually work it out, it's easy. The first thing we do when you come across this kind of adjustment, we have to go back to our trial balance to see if we already have a provision for doubtful debt. And as you can see, we do. We have 2,281. So we write it down in our working out so we know what our old doubtful debt was.
For the ones that don't know what doubtful debt means, is basically when a trade receivable, the people that owe you money no longer have the capability to bring you the money. So you just have to cross it out. In this case, it's telling us that the doubtful debt is 5% of our trade receivables. So we do our trade receivables times 5% to get our new doubtful debt. Then we will have to see if there's been a decrease or increase in our doubtful debt. So we do 4,375 minus 2,281. And then we have to put the new doubtful debt into our trial balance. So we just remove the old one and put the new one in. And then we will have to also put the increase, because the increase is an expense obviously, because they cost the business. Next, depreciation on motor vehicle is to be depreciated at 13,000. This has got to be the most easiest adjustment out of all of them. So you go back to our worksheet and we write depreciation equals 13,000. So this goes into our income statement because it's an expense. Then we do provision for depreciation, which is our original depreciation, which is 28,500 plus our new one, 13,000. Again, same process, we put it back into our trial balance so we don't forget. So we will add it to the provision for depreciation in trial balance also, and then we will also open up another one called motor depreciation. Last adjustment. Depreciation on equipment is to be provided using the straight line method at 15% per annum. Okay, so we will go back to our working sheet where we do our workings obviously. So how do you work out the depreciation using a straight line method? It's cost minus residual value times percentage. So first we go to our trial balance to see how much it cost us to buy the equipment, which is 38,800. Then we look for residual value. We haven't been given any residual value, so we just ignore that. But we've been given the percentage, so we times it by 15%. Okay, so now we have the depreciation of the year. We must add that to our provision for depreciation. So we do 5,820 plus our provision for depreciation, which is 12,865, and we find this in our trial balance obviously. Again, we put it back into our trial balance, so when we're doing the transferring the figures, we do not forget.
As you can see, we've finished with our adjustments, so we will start transferring the figures.
I won't be speaking through this, but there's a section where I transfer the doubtful debt. It might be a bit confusing for you, so I'll have a little say when it comes to that. So I've already told you that doubtful debt is the amount of money that you will not receive for an item you've sold on a buy now pay later basis. So we have this amount, okay? We can subtract this from trade receivables before we put it in the statement of financial position, but I prefer to subtract it within the statement of financial position, so I have everything laid out. Your teacher will probably prefer my way, but you can do it the other way as well. Alright, so we have finished transferring. Our last and final step is to calculate. First calculation is net sales. That's sales revenue plus sales return. Next, cost of sales. Cost of sales is opening inventory plus purchases minus purchase returns, but we don't have any purchase returns and we don't have any carriage inwards anyways. So we just forget about them. Subtract closing inventory. And then we have gross profit. That's net sales minus cost of sales. And then for other income, we only have discount received, so it's right, 2,375. Next on the line is expenses. We have to total them up. So we do discount allowed plus operating expenses plus rent and rates plus wages plus increase in doubtful debt plus motor depreciation plus equipment depreciation. Then we have to work out the profit or loss of the year. So we do gross profit plus total income minus total expenses. In this case, we've got a negative value. That means they've made a loss for the year. So we put the value in a bracket to show that it's a negative. And we also remove that profit and we just write loss of the year. We must not forget to put our loss of the year into our finance by section. Next is statement of financial position. So we first do total non-current assets. That's equipment plus motor vehicles, but we use the value on the right side. Next is total current assets. We use the values I have in the middle. So we do bank plus trade receivables, but the one in the middle, 83,000. Then we do plus closing inventory plus prepayment. Next we have current liabilities. That's trade payables plus accrual expense. Net current assets. That's total current assets minus total current liabilities. And then we do not have any non-current liabilities, so we just put a 0 in there. And then for net assets, we do total non-current assets plus total current assets minus total current liabilities.
Okay, next on the list is the finance by section. So we do opening capital minus loss of the year minus drawings to get closing capital. Right, so now we have 103,702 is the same as net assets. That means our answer is correct.
Alright, so that's the end of the video. If you found it helpful, please like and subscribe and turn on the notification bell for whenever I post another one. Thank you very much for watching. Goodbye.